Well, hello, hello, hello. Josh Thomas, mortgage broker here in Utah, and I hope you're having a great day. And just wanted to bring a couple things that I experienced with my clients over the last week and share those. I have loved this job for 22 years because of a lot of different reasons, but one of them is that I feel like it gives me this inside look into people's lives. That you don't really get any other way. And frankly, I love hearing about other people's lives, those secrets that people don't really like to share with others, because first off, I know that somebody else is struggling in certain ways because I know I'm struggling in certain ways. And when I see somebody else going through it, it makes me feel better that I'm not the only one. But two, I really like seeing the solutions. And so I want to share in this live broadcast, if you will, I want to share just some of the different challenges people are facing and some of the solutions that we're finding together. And so I'm going to try, I don't know if this is going to let me, I'm not real experienced, if I can share my screen or not, but I am going to try at least to figure it out. So window, there we go. So the first one I'm going to go ahead and share. You should be able to, on my screen, see a bunch of boxes and numbers in theory. And if you share, what you're looking at is somebody's income. They making $6,500 a month, $5,900 a month. So combined, they're making $12,000, about $150,000 a year for this couple. So not too bad income wise. Both of them are working. Over here is their debts. So this is how much they owe. These are the monthly payments that they have. And so one borrower has $28,000 they owe for $903 a month. The other one has a little bit more than what's being shown because we have some separation. So they have a mortgage and a couple other things that we're kind of omitting here. But basically, they're paying $1,500, or they've got $51,000 in debt and about another $980. So if you combine these two debts together, we're over $1,800, and this is going to be really important in a little bit. So why I'm sharing this, and maybe I should have given you some backstory beforehand. So this is a couple that came to me because they wanted to move. They have a house, they want to sell a house and then go buy another one. And a lot of people maybe have misconceptions about consolidating debt and how to manage it. These guys wanted to run the different scenarios to see, how much of this debt can they consolidate and what makes sense and should they. Those are questions that people often will ask. And so I just kind of wanted to walk you through their scenario. So I'm going to keep walking you through, and then I'm going to talk a bit more about it. So down here, they're not sure what their house will sell for. It's a smaller home in a community a little bit away from the main Salt Lake area. And so they might sell their house. It could be as much as 400, but we've been playing with numbers in the 375, 350 range. And the house it's actually a really great lot, but it's really run down. They kind of inherited it, and they weren't really sure if they ever wanted to, remodel it and stuff. They've kind of just been living in it and not really, making all the updates. And for a good reason, they weren't sure if they were going to stay there, and now they're trying to move. So we estimated if they sold it, for whatever they sold it for, this is how much they would walk away with, 123 grand based on how much they owe. And if I think worst case scenario, we figure out we can sell it for 325, that puts $101,000 in their pocket. So I'm going to take you to another screen now, and these numbers are much bigger, maybe easier to see. So these two loan options, each column is a different loan option. You can see both of these are showing 20% down on a $520,000 house. So a house, quite a bit nicer. And it's got them bringing something, close to $100,000 to closing. And they're looking at monthly payments between $28,000 and $3,000 a month. So this is part of what they were looking at and thinking, well, let's see, what option would we prefer? So if they do this one, they have the money or thereabouts, if they get the seller to pay some closing costs. Let's just say they ask the seller to pay $10,000. There we go, almost. If they got the seller to pay $10,000, again, their money out of pocket should be somewhere, depending on what they sell it for, at least 100,000, and they've got $76,000 besides that saved. So great savers. So they can handle this. They can bring the $110,000 to closing, and they're looking at this $3,000 a month. Now, right now, they're paying $1,500, and so this would be a $1,500 increase in their budget, maybe a $1,300 increase in their budget. So they're asking questions like, well, what if we took some of that money and we consolidated it? And they were asking questions about multiple different debts, like what if we did this debt or these two debts or that three? And so I'm just going to show you an extreme where, again, they owe 50,000 there, 28 there, so roughly 80,000 for roughly 1,800 a month. So if they sell the house and they walk away with $101,000, they have enough to pay all of the debt, leaving none of it, right? 100% of the debt is gone at this stage, right? So if they pay 100% of the debt, they're going to be left over with about $20,000. So that's what these other scenarios are for, right? These 4 scenarios are all either 5% down conventional or 3.5% down FHA. And so these 4 scenarios you can see down below, they only have them bringing $22,000 to $35,000. And then these are the corresponding monthly payments. Another interesting angle on this particular loan is their credit scores aren't really, really strong. They're in the high 600s. And conventional doesn't really like 600s for credit scores. It really likes the 780, 800 credit scores. And when I say likes, what I mean is that they give you higher interest rates and higher mortgage insurance when you have a lower credit score. Conventional really likes the high stuff. FHA, on the other hand, is pretty open, pretty cool about it. So that's why if you look at these 2 scenarios, you've got convention or FHA's payment as low as $3,400 a month with only $25,000 out of pocket, versus the conventional is another $5,000 out of pocket, but the payment's $300 a month higher. And so FHA kind of comes in strong when they're looking at this higher, this smaller down payment. When we were running these 2 scenarios for them and we were comparing it with FHA, these 2 scenarios were drastically cheaper than the FHA options. So when you're putting big money down, conventional is pretty strong. When you're putting little money down, especially if your score's in the 600s, the FHA can be pretty strong. Anyway, so circling back, so their monthly payment's going to go up. This is a best case scenario of $2,800 versus $3,400, so it's $600 more expensive to go with this option. So it increases their budget $600. However, it removed all $1,800 a month of their debt. Remember that? So they save $1,800 a month in their debts, but they are increasing. It's actually almost $1,900. But their house payment's only going up $600 from kind of a best case scenario. So in other words, these guys are buying a house, a much bigger house, $520,000 versus $325,000, $350,000. They're buying a $520,000 house, and out of pocket's about the same either way. They're having to bring an extra $5,000 or $10,000 maybe of their own savings. But in this scenario, their monthly budget is actually going to drop by $1,200 a month. They're going to save $1,200 a month doing this one. Now, remember, the difference between these 2 scenarios was their rent, right? Their rent was only their house payment currently is only $1,500. So that means their payment was going to go up $1,300 and they still had all the debt, right? So their monthly budget was going to increase a lot. In this scenario, their monthly budget, so this is $600 cheaper or more expensive than this option, but there's $1,800, there's $1,200 savings. So they're already paying $1,500, right? So they're currently paying $1,500 plus $1,800. So what is that? It's $2,800, right? Sorry, I'm doing too many different mathematical equations in my head and I'm getting confused. You're paying $1,500, your payment's about to go up $2,000 a month, but you're actually removing $1,800 a month. So in this scenario, they get to buy a nicer, bigger house, and it's only going to cost them an extra $200 a month, because right now they're paying $1,500 and $1,800, right? So $2,800. Is that what you're doing? So if they're paying $1,500 and they're paying 1,800. That's 3,300 a month, right? If I'm doing my math right. Sorry, this is live and I'm like fumbling here. And I'm a finance guy. Trust me with your finances. Anyway, so yeah, so this is just a pretty cool indicator. They're already paying 3,300 bucks a month. They can basically end up paying something similar, and they can get the kind of the house of their dreams. In fact, they're super excited. They're actually already under contract with this house, and they love it. They say everything about it. So it really is the house of their dreams, and they plan to never move again from it. So, and just to drill down a little bit further, remember when you get financing. So right now their mortgage is tiny. It's only 100 and what was it, 193,000, and with the monthly payment of only 1,500, that tells you that they have a very low interest rate on that, and so they're not getting any tax benefits from it currently because they're taking the standard deduction. Where on this new loan, they're going to have a $500,000 loan, and that 500,000 is going to be at 5.25%. So 5.25%, 510, we'll call it, times 0.0525 is going to be $26,000 in interest each year. So that's going to be an extra probably $16,000 of interest that they're not spending today. That's going to become tax deductible. So that stands to reason that their tax refund is going to increase a little bit from making this bigger payment. And if it's only a $1,200 increase in their tax refund as a result of buying the house, their annual tax refund goes up by $1,200 as a result of buying it. If that's the case, then that means they're actually going to save that $100. Uncle Sam's basically paying $100 of that $3,400 a month. And if you stop and ponder that just a little bit, that means that they're literally exchanging a bigger house for the same monthly budget as what they're currently paying now. So that's one of the reasons I thought this would be a good, valuable talking point. I should get some invited guests and be like these cool podcasts that have other people on them, to just kind of share that to begin with, give us something. And I would love if you watch this video at a later time and you want to, because I don't see anyone on with me at the moment. But yeah, just if you're watching this, hit me up with some thoughts or insights that you have about that. It's kind of cool, right? Be able to upgrade your housing substantially, moving into the house of your dream, and not have to actually change your budget at all. That's a pretty big deal. So that was pretty cool. Another thing that I thought I would talk about today. So this one, it's kind of, it's very different actually. It's another family that's trying to move. So credit scores, how low of a credit score can you go? That's one of the questions that people often ask. And when their scores and credit are as bad as this family's, a lot of times it's not even about, what the loan is, but can we even get one? So this scenario, I was introduced to them very recently and had a conversation with them. And in the world of credit, remember 750 is kind of the upper limits, where it goes up to about 850, but 750 to 850 is where really great credit resides. If you got a 750 to an 850 score, somewhere in there, it's a strong credit score. I think 780 is like the upper limits of any benefit that you get from our limit. Like our mortgage insurance is really good if you're doing a conventional loan at 780. But under 750, you can go down to basically 580 on a credit score and still have most of your FHA financing options available. Well, you may not realize this, but FHA actually opens up all the way down to a 500 credit score. So if you have a 500 credit score, you, in theory, can still get an FHA loan. Now, I say in theory because the bank has to still lend you the money, and then FHA will insure that loan for the bank and or purchase the loan. When that happens, the bank's happy, but so many banks will struggle to get that, to get it insured with FHA, that they won't even do it. So basically, from about 580 down to about 500, there's just more and more strings that get attached to where it's almost impossible. For example, as a mortgage broker, I really only have just a couple options that go down to 500, a couple lenders that will actually go down to 500. I've got one that goes down to 530. I got another couple that go down to 550. And then most of the rest of them are around 580. And so I have severely limited options under 580. But in this family's, I'm going to tell you a little bit of their story, because you're going to be tempted to judge them, of course. Anybody that's got a 500 score. In fact, I've joked around for years that if you have you have to try almost as hard to have a 500 score as you do to have a 800 score. And we joke around a little bit about that because it's almost like you have to intentionally not pay a whole bunch of things. And I mean, a whole bunch of things. You have to actively be behind on quite a few things. It's not just a few collections. It's not just a bankruptcy. Those are all going to be in the 500s. But when you have all those things and you have active late payments, like your credit card, you haven't paid it in 3 months and they're getting ready to charge off, or you have an auto loan that is threatening repossession, or a mortgage that's threatening foreclosure. Those combinations, all of those things combined, now you're starting to flirt with under a 500 credit score. And surprisingly, we do pull quite a few credit reports under 500. It's quite remarkable why anybody would ever have a conversation with me when they know they're late on stuff. It's like, really? What do you expect the bank's going to tell you if you're actively late on things? Kudos for having the courage to do that. But keep in mind, it cost me $100 to pull your credit report. So maybe you want to get current before you call. Anyway, this particular scenario, I'm glad that we've talked. We actually haven't pulled their score yet, but this particular scenario, they had a severe accident at work. He almost died. Actually, he should have died. I think everybody thought he had died in the accident, and found out that he had not. Was fully paralyzed as a result, but miraculously has been healing and is actually able to walk again, and lots of other great recoveries. But 6 months after his accident, the wife ends up getting diagnosed with stage 4 cancer. Crazy hard times, right? And on top of all this, they find out that their adult disabled son, disabled from an accident years before, was then being taken advantage of fraudulently and being treated extremely badly by his caregivers. And they were literally embezzling and stealing and taking, anyway, so horrible story. No one, I think I would have a terrible credit score in this scenario. Who's going to care about your credit and your bills when something like that's all going on? In any case, though, light's starting to shine. They're kind of, coming back from their struggles, and they're, interested about buying a house. And so this discussion led to this perspective that I wanted to share. So like I said, FHA is willing to go down to a 500 score. You do need to be on time on everything in order to really probably have a 500 score. If you're actively late, get things caught up if you all can. Once you can get them at least caught up, you don't have to pay them all off or anything. You don't have to repair them or anything. You just have to have the bleeding stopped, if that makes sense. The active open accounts that are still open, get them paid current, and just pay the minimums. And that's when I'm going to be able to pull like a 510 or 530 or something like that. And the trick with an FHA loan is you have to have 10% down. Well, these guys are actually planning on doing 25% down. And so they had the 10%. And I talked to her about using some of that 25% down to actually bring those loans current. So they're exploring that. But beside that, I'm going to try something else with them, and I'll have to let you know later on how all this goes. But Fannie Mae, the conventional loan, recently changed their guidelines. By recently, I mean like 3 days ago. They updated their software to reflect this. So they have historically required a 620 credit score minimum. And then a while ago, they kind of adjusted that so that it's just a 620 average, which is a super weird calculation in our industry. And then after that, they, like I said, just barely just removed the minimum. There is no minimum credit score. There are scenarios where people call me up and they only owe 10, 20, 30% on the house, and they just need to restructure things. And their credit's horrible, but the reality is the equity position's crazy strong, and every bank recognizes that. Well, Fannie Mae decided that they're going to open this up, and probably for the same purpose. I can't speak with a lot of authority on this yet because it's kind of all brand new. But I plan on, once I get a credit score, regardless of 500, actually, I'm planning on running it through Fannie Mae's automated underwriting system and seeing kind of how it judges it. So on this one, I probably have to have an automated approval from Fannie Mae. If I don't get that, I probably won't be able to make any progress on it, though I'll vet that out. But on FHA, I actually don't have. I have to do. So if you don't know this, every agency has an automated underwriting engine. So it's a sophisticated computer program that looks at the application, the credit report, does some mini background checks into income and assets, and kind of blends it all together and kicks back some, an approval or something like that. Well, with FHAs, I don't need that approval. In that one, I can literally do what's called a manual underwrite. In a manual underwrite, I just have to meet certain criteria of compensating factors. So examples of compensating factors would be residual income, not like a multi-level marketing, but residual income. Like I make $5,000 a month, I have $2,000 a month in debts, I have $3,000 residual income. So I have to have enough residual income, or my payment is already as high as my new payment's going to be, so there's no payment shock, or extra reserves if I have months of savings, or things like that. There's a handful of defined compensating factors. If I have those compensating factors, I don't have to have FHA's approval, their automated approval. So I actually have pretty high hopes for this lady and her family and being able to get this together. I just need to get her credit score up over 500 for the FHA one to work. But I kind of wanted to share that with you guys today. Anybody watching this, because I think there's a lot that goes on behind the scenes in the mortgage industry that a lot of people don't recognize. And frankly, I think that there's a lot of value in people recognizing this. So hopefully this is a decent little message to listen to while you're working out or driving up or down the road. And I know in the world of podcasts, you tend to want them longer than this. So I apologize that I'm not more long-winded, but this is number, I think, 2, if you see on the channel, of this style. And you can watch both of them or listen to both of them or whatever. And hopefully my voice doesn't put you to sleep. If you're driving a commute, that'd be bad. Unless, of course, you're driving your Tesla or whatever automated driving model you have. Man, talk about automated. Is anybody else excited about automated? It seems like everybody's nervous about this, but I remember the movie I, Robot with Will Smith, and that looked super cool to me, where the robots drove safer than the humans. Let's not lose sight of the fact that the humans also have accidents all the time. And yeah, if the computer has an accident, that's a bummer. But kudos to Tesla and those that can calculate those incredible programming features that enable these machines to drive us around. So if that's what you're in and you're doing, and you're listening to me, and I'm putting you to sleep, then I wish you well. Hope you have some sweet dreams. And my voice is that consoling to you, then good for you. But for those that are working out, get that one more rep, one more set. Come on, push yourselves a little bit more. Just stretch past what you always do. Get that little extra, right? Anyway, but that's kind of what I wanted to cap out today, as far as just kind of where things are at. I guess I'll add a little bit, since this is going to be kind of a weekly thing for me. With interest rates and home prices, I guess I may as well add that too. Every Friday, I'm putting out a quick little video on my Instagram. I think I share it here on my shorts about just kind of where the market's at and going. Rates are still at their historic lows, guys. Not historic like forever and ever, but historic since 2022. They're right in line with where the lowest rates were in 2024, which was amazing. We actually have beat that level a couple times recently, and we may do that again. The more rates are low like this, the more you'll see home prices recover. Nationally, I think home prices went up about 2.8 or 2.4%, but locally we're actually up over 4%. And so we already have high prices, and we're still climbing. And the reason we're still climbing is because our industry, our business, our literally our state motto, the beehive state, the industry, the work. That's it. We have one of the lowest unemployment rates in the country, and it's been that way for a couple decades. So as long as that remains, you're going to find people continuing to come here looking for work, which is going to continue to drive our home prices up and expand our housing and our economy. So that's kind of the future. I expect home prices will actually be pretty firm through the winter. Usually they soften up a little bit. I think they're going to be pretty firm here in Utah, and possibly growing 3, 4, 5% by spring. So get them while they're hot. Anyway, pass this on or share this on with anybody else you think might value from it, or benefit from it. And let us know if you need anything else. Just reach out and message us. Talk to you later. Have a great day.